Build your dreams, live rich, and leave rich.
Welcome back to the deep dive. Today, look, I'm going to be honest with you right off the bat. When I looked at the topic sheet for this week, my first instinct, my visceral gut reaction, was to groan.
Oh,
That bad.
it was. I saw the words health insurance and I immediately wanted to take a nap. It feels like homework. It feels like taxes. It's that thing we all know we should figure out, but we'd rather, watch paint dry or reorganize our sock drawer. It's tedious, it's confusing, and quite frankly, it's a little depressing.
I completely get that. It's not exactly the thrill of buying a new car or checking your crypto portfolio on a good day. It's administration. It's boring.
Exactly. But then I started reading the research packet you sent over, specifically the data from the Legacy Diary and that stack of expert video analyses. And about 5 minutes in, the boredom vanished.
And what replaced it?
Fear.
Yeah.
Genuine cold sweat fear. Because I realized I've been walking around with a massive hole in my pocket and I didn't even know it. I realized that my entire financial plan, everything I've been building, is sitting on a foundation that might just be styrofoam. That is the reaction we are aiming for. Not panic. Panic is useless, but a wake-up call. A jolt to the system. We are talking about the foundation of your financial house today. And if the foundation is cracked, it doesn't matter how pretty the curtains are or how big the TV is.
We are. And the phrase that stuck with me from the intro of the research, and I want to start here because it really set the tone, was this. The Indian middle class is just one hospital bill away from poverty.
It hits hard, doesn't it? It's a very stark statement.
It does, but let me play devil's advocate for a second. That sounds like a headline designed to sell newspapers. One hospital bill away from poverty. Is it really that fragile? Because most people I know feel like they're doing okay. They have savings, they have jobs, they have an SIP running.
It sounds dramatic, I agree. But let's dismantle the Legacy Diary data and just look at the raw math. Think about the trajectory of a typical middle-class life. We spend our 20s and our 30s climbing a ladder.
Right. You work hard, you get that promotion, maybe you switch jobs for a hike, you go from lower middle class to middle class, you buy a car, you start an SIP, you are climbing, you're focused on moving up.
You're focused entirely on the ascent. You are looking up. But what this deep dive highlights is that we completely ignore the trapdoor we are standing on.
That trapdoor.
It is a trapdoor. Every day you go to work, you are standing on it. And that trapdoor is a medical emergency. The data shows that for a typical middle-class family, a single event, a cardiac issue, a nasty road accident, a cancer diagnosis doesn't just pause your financial growth. It doesn't just mean you don't save money this year. It wipes you out.
Wipes you out as in back to zero.
Or negative. Think about it. If you have worked for 5 years and saved, say, 10 lakhs in mutual funds, which is a great achievement, by the way, and a medical crisis hits that costs 15 lakhs, what happens?
You lose the 10 lakhs.
And you are in debt for 5 lakhs, you are now negative, you've fallen off the ladder and you've hit the basement, you are likely taking a personal loan at 12 or even 15% interest just to pay the hospital. The climb is over. Now you are just trying to survive.
That is a terrifying visualization because we usually think of wealth as our assets, my mutual funds, my PPF, my gold. But you're saying wealth is actually our resilience, our ability to take a punch.
Precisely. If you cannot withstand a shock, you aren't wealthy. You're just lucky. And luck eventually runs out. It's the difference between being rich on paper and being financially secure in reality.
Okay, so if the stakes are that high, if we're literally gambling with our financial survival, why is our attitude towards it so casual? I mean, I hear people say, oh, insurance is a scam, or I paid premiums for 5 years and didn't get sick. What a waste. I've said it myself.
That right there, what a waste, is the single most dangerous mindset in personal finance. It is the mental block that keeps people vulnerable. It's a fundamental misunderstanding of what insurance is.
How so? We want a return on our money. That's human nature. If I put money somewhere, I want to see it grow, or at least get something back for it.
Let's use an analogy that the Legacy Diary uses, which I love. Think about your car. You have car insurance, right? It's mandatory.
Yes, I do. Have to have it.
If you drive for a year and you don't crash your car, you don't hit a tree, you don't rear-end anyone, do you call the insurance company on December 31st and scream at them? Do you say, hey, I didn't get to smash my bumper this year, I want my money back?
No, obviously not. I'm relieved I didn't crash. I'm happy the car is in one piece.
Exactly. You understand intuitively that with a car, you paid for the protection, not the event. You paid for the peace of mind of knowing that if you crashed, you wouldn't be bankrupt. But with health, we have this transactional mindset. We view our bodies as assets that should give us a return on investment.
You think, I paid 20,000 rupees, I should get 20,000 rupees worth of services.
Right. And if we don't get sick, we feel cheated. We feel like we lost a bet. But the sources are very clear on this. Insurance is not an investment product. It is a risk management product. You do not buy it to make money. You buy it so you do not lose the money you already have.
That distinction is key. It's a defense mechanism, not an offense mechanism.
It is the goalkeeper. The goalkeeper doesn't score goals. But if you don't have a goalkeeper, it doesn't matter how many goals your forwards score, you're going to lose the game.
I love that image.
Yeah.
The goalkeeper. Okay, so the goalkeeper. But this brings us to the next big hurdle, the cost versus the coverage. Because this is where I feel like the advice has shifted over the years, and I'm a bit confused. It's not what it used to be.
You mean the how much is enough question?
Exactly. I remember when I got my first job, my dad, who is very financially prudent, told me, get a 5 lakh policy. It's a good amount. It covers everything. And honestly, 5 lakhs feels like a lot of money to me.
Ah, the 5 lakh myth. This is a legacy mindset from maybe 2010, and it is one of the hardest myths to kill. It's anchored in people's minds.
Why is it a myth? 5 lakhs is 5 lakhs. It's a substantial sum of money. It can buy a small car.
It was a substantial sum, for medical care at least, but we have to talk about the silent killer that people massively underestimate. Medical inflation.
I know inflation.
Yeah.
Milk gets more expensive. Petrol gets more expensive. It's like 6 or 7%, right?
That's CPI, consumer price inflation. That's the price of bread and shirts and movie tickets. But medical inflation, the cost of drugs, new technology, robotic surgery, imported stents, doctor's fees, even just the hospital room itself. The data in our sources suggests that NOCRA is sitting closer to 14%.
14%. That's double the normal rate.
It's massive. And because of the rule of compounding, a 14% inflation rate means costs triple roughly every 10 years.
Whoa. Hold on. Let me process that. Costs triple every decade.
Yes. So let's look at your safe 5 lakh policy. Let's say a major heart surgery costs 4 lakhs today. That fits comfortably in your 5 lakh policy, right? You feel safe, you sleep well at night.
I feel covered. I have a 1 lakh buffer. I'm good.
But you are, say, 30 years old. You aren't buying insurance for today. You are buying it for the future, for when you're older and more likely to need it. In 10 years, when you are 40, that same 4 lakh surgery costs 12 lakhs. In 20 years, when you are 50, which is when you're actually much more likely to need heart surgery, that cost is 36 lakhs.
And I'm sitting there with my 5 lakh policy thinking I'm smart.
And that 5 lakh policy will barely cover the admission fee and the cotton swabs. You are bringing a pocket knife to a bazooka fight. You are operating on outdated math.
Okay, that visual is terrifying. But here's the skepticism kicking in again. If you're telling me I need to plan for 20 years from now, I need, what, 50 lakhs? 1 crore?
Ideally, yes. The experts we analyze suggest thinking in terms of 25 lakhs, 50 lakhs, or even 1 crore as a family floater.
But come on, let's be realistic. If a 5 lakh policy costs, say, 10,000 rupees a year, then a 50 lakh policy must cost 1 lakh. I can't afford that. Nobody I know can afford that. It sounds like an upsell.
And this is the aha moment of the deep dive. This is where we earn our keep today. This is the secret that insurance agents often forget to explain properly. The answer is NO. The premium does not go up linearly.
Explain that. Why wouldn't it? 10 times the coverage should be 10 times the price. That's how buying apples works. That's how buying land works.
But insurance isn't apples, it's probability. Think about it from the insurance company's perspective. What are the odds that you, a healthy person, will have a claim for 2 lakhs in a given year?
Pretty high, I guess. Dengue, a minor fracture, food poisoning, appendicitis, those things happen all the time.
Exactly, high probability. So they charge you a decent amount for that first layer of risk. They know they will probably have to pay it. Now, what are the odds you'll have a claim for 45 lakhs?
Very low. That's catastrophic territory. Major organ transplant, a massive car crash, a long-term ICU stay for a rare disease.
Correct. The probability is tiny.
Okay.
So the insurance company charges you very little to insure that top layer of money. The risk for them is minimal.
So the first 5 lakhs is expensive, but the next 45 lakhs is cheap.
They're cheap, relatively speaking. It's the most cost-effective protection you can buy.
So how do we structure this? Do I just walk into an office and ask for a 50 lakh policy?
You could, but the smartest way, the financial engineering way that the Legacy Diary recommends, is to use something called a super top-up.
Okay, let's slow down. Super top-up. I've heard this term, but I've never understood it. It sounds like marketing jargon. Define it like I'm a smart 15-year-old.
Imagine your health insurance is a layered cake, a 2-layer cake. The bottom layer is your base policy. Let's say that is 5 lakhs. You pay a normal premium for this. If you get sick, this pays first. It's your first line of defense. The top layer is the super top-up. Let's say this is 45 lakhs. But, and here's the key, this layer has a deductible of 5 lakhs.
Deductible. That means it doesn't wake up until the bill hits 5 lakhs. It's asleep until then.
Exactly. The super top-up says, I am the backup. I am the special forces. I will only pay for bills above 5 lakhs. The first 5 lakhs is not my problem.
And because it only handles the huge, rare bills.
It is extremely cheap. You can often get a 20 lakh or 30 lakh super top-up for maybe 2,000 or 3,000 rupees a year.
Wait, really? The price of a large pizza dinner and a few drinks gets me 20 lakhs of extra coverage? That sounds too good to be true.
Yes, it is the greatest arbitrage in personal finance. It's almost a loophole. So let's do the math. You combine them. You buy a 5 lakh base plan for, say, 12,000 rupees. You buy a 20 lakh super top-up for 3,000 rupees. Total cost, 15,000. Total coverage, 25 lakhs.
Whereas if I bought a single 25 lakh policy,
It might cost you 25,000 or even 30,000 rupees. You just save 50% of your premium by understanding the structure. You get the same protection for half the price.
that is brilliant. That is literally actionable right now. I can feel the listeners pausing the deep dive to go Google this.
They should. But one warning. Check the wording carefully. There is a massive difference between top-up and super top-up.
Oh boy. They make it confusing on purpose, don't they? It sounds the same. What's the difference? This feels like a trap.
A standard top-up, without the word super, applies the deductible to every single claim. A super top-up applies the deductible to the total annual bill.
Okay, give me an example. I need to visualize this. This is where the fine print gets you.
Sure, you have a plan with a 3 lakh deductible scenario. You get hospitalized twice in 1 year. It happens. First time, for a bad fever, maybe jangle, the bill is 2 lakhs. Second time, a few months later, for a knee issue. The bill is another 2 lakhs. Total bill for the year is 4 lakhs.
Okay, so I've spent 4 lakhs. My deductible is 3.
A normal top-up looks at the first bill, 2 lakhs. Is it greater than the 3 lakh deductible? No. It pays 0. Then it looks at the second bill, 2 lakhs. Is it greater than 3 lakhs? No. It pays 0. You get nothing from the top-up. You paid the whole 4 lakhs yourself after your base policy was exhausted.
Even though I spent 4 lakhs total. That sucks. That's a terrible product.
It is. It's almost useless. But a super top-up looks at the aggregate. It adds up all your bills for the year. It says, okay, total bills this year are 4 lakhs. Your deductible is 3 lakhs. We will pay the remaining 1 lakh.
Okay, so always go for super top-up. The other one is a trap.
Always super. Never settle for the regular one. It's a small word with a huge financial impact.
All right, I'm sold on the super top-up. It makes the go big strategy affordable. But I can hear a huge chunk of our listeners tuning out right now. They're thinking, guys, relax. I work for a big tech company. I have the golden card. My employer covers me, my wife, my kids, and my parents. Why should I spend my own money? Insurance is free for me.
Ah, yes. The corporate cover trap, or as the experts call it, the golden handcuffs.
Why is it a trap? It's a great perk. It saved me money. It's one of the best parts of my compensation.
It feels like a perk, but the cost is hidden and it is high. You are renting your security. You don't own it. Let's break down the dangers highlighted in the source material. First, the obvious one, job loss.
We've seen a lot of layoffs recently in the tech sector. It's been brutal. It's on the news every other day.
Exactly. Imagine this. It's Tuesday. You get called into a Zoom meeting. You're laid off. Your access is cut. By 5 p.m., you are metaphorically walked out of the building. You're unemployed. Guess what happens to your health insurance at 5:01 p.m.?
It vanishes, just like my email access.
Poof. Gone. You are naked in the middle of a storm. And here's the cruel irony of life. Stress causes health issues. The stress of losing a job triggers a heart attack or a hypertension crisis a week later. You rush to the hospital, you pull out that corporate card.
It's a piece of plastic.
Rejected. Now you are unemployed A&D facing a 10 lakh bill. This destroys families. This is how bankruptcy happens.
That's nightmare fuel. Pure nightmare fuel.
It gets worse. Let's talk about the parent problem. This is really specific to our culture, and the sources highlight it beautifully. In India, we look after our parents. It's non-negotiable.
Right, it's a given.
Many corporate plans offer parental coverage. It's amazing because buying private insurance for a 65-year-old is tough and expensive. So you rely on the company cover. But then you start to hate your job. Your boss is toxic. You aren't growing. You want to switch industries, or maybe you want to start that startup you've been dreaming of.
But the startup doesn't cover parents, or has a very small cover.
Or your own business has zero coverage. So what do? You stay. You are held hostage by the policy. I have met people who have stayed in stagnant, soul-sucking jobs for 5 years past their expiration date, purely because I can't risk losing mom's dialysis cover.
That is tragic. You are paying for that insurance with your career potential, with your happiness. The premium is your own life.
Exactly. If you had bought independent insurance for your parents 10 years ago, even if it was expensive, you would have the freedom to walk away today. You'd have options.
So the advice is, treat corporate cover as a bonus, a nice to have, not your primary shield.
Exactly. Have your own personal policy that travels with you, no matter who signs your paycheck. Buy insurance so you can be the CEO of your own life, not an employee of your own fears.
What about retirement? That's the other cliff edge, isn't it?
The 60-year cliff. You work until 60, you have great corporate cover, you retire, you get a farewell party, you hand in your badge. Now you need to buy a private policy. But you are 60 years old.
And likely have some blood pressure issues, maybe some knee problems, a little bit of diabetes.
Exactly. Now you are trying to buy insurance when you are high risk. The insurer says one of three things. 1, no, just a flat rejection. 2, yes, but the premium is 1 lakh a year. Or 3, the worst one. Yes, but we won't cover your heart or your knees. They add permanent exclusions for the very things you're likely to need cover for.
So you are entering the most physically vulnerable phase of your life old age, completely defenseless.
Precisely. The time to buy the parachute is before you jump out of the plane. You need to buy that private policy when you are 35 or 40 alongside your corporate cover. Let it run in the background.
So relying on corporate cover is basically betting that you will never be unemployed, you'll never want to change jobs to one with less coverage, and you will never get old.
Correct. It's a bad bet. It's a bet against reality.
Okay, let's pivot to the thing that scares people the most. The paperwork. The fine print. The rejection. We've all heard the stories. I paid for 10 years, and when I finally needed it, they found a loophole and denied the claim. Is it a scam? Are they all out to get us?
It's not a scam, but it is a strict legal contract, and you need to treat it as such. The sources are very specific here. They state that about 90% of claims are settled. The industry isn't out to get you, but when rejections happen, they're usually due to non-disclosure.
Lying on the form.
Or not even lying intentionally, just withholding information because you think it doesn't matter. The sources give a great example, the inhaler.
The asthma inhaler.
Yes. Let's say you have mild asthma. You use an inhaler maybe twice a year when the weather changes. You think, I'm not asthmatic, it's just a seasonal thing, so you don't mention it on the application form.
Seems harmless. I wouldn't think to mention it either. It's not a major illness.
Fast forward 5 years. You have a lung issue or even a heart issue that could be remotely related to breathing. You get hospitalized, the doctor takes your history, you tell the doctor, yeah, I use an inhaler sometimes. The doctor writes it in the notes. The insurance investigator sees those notes. They compare it to your application form from 5 years ago where you checked no for respiratory issues.
And boom.
Claim denied. Hiding material facts. And they might even cancel your policy entirely and keep the premiums you paid.
So even if the claim is for something unrelated, they can do that.
If they find you lied about your health history, they can argue the contract was void from the start, that you entered it on a false premise. The advice from the experts is crystal clear. Vomit the truth on the application form.
Vomit the truth. That's a memorable phrase.
Tell them everything, even the small stuff, even the thyroid pill you take, even the surgery you had 10 years ago for a sports injury. It is better to pay a slightly higher premium, which is called loading, and have a valid policy than to pay a lower premium for a worthless piece of paper.
That's a powerful way to put it. A policy that doesn't pay out is just an expensive piece of paper.
Right.
Now, I want to talk about room rent capping. I saw this in the outline and it sounded technical, but the notes say this is a wealth destroyer. How can a room rent limit destroy wealth?
This is the biggest gotcha in the fine print, and it explains why people get partial settlements and then go on social media to complain that the insurance company cheated them. Many older or cheaper policies have a rule. We will pay room rent up to 1% of the sum insured per day. So if you have a 3 lakh policy, your room rent limit is 3,000 rupees per day.
3,000 rupees. In a metro city like Mumbai or Bangalore, you get a bed in a shared ward for that. You certainly don't get a private room.
Exactly. So you go to the hospital and you say, I want a private room. The hospital says, sure, that's 8,000 rupees a day. You think, okay, the limit is 3,000. The room is 8,000. I'll pay the extra 5,000 rupees difference from my pocket. It's just for 4 days, 20,000 rupees. No big deal.
That seems logical. I pay the difference. I can afford 20,000.
That is the trap. It is not just the difference. If you pick a room category higher than your eligibility, the insurer triggers a clause called proportionate deduction.
Proportionate deduction. That sounds ominous.
It means, since you picked a luxury room, we assume this is a luxury treatment. They will slash every other line item on the bill by the same percentage. The doctor's visit fee, slashed. The surgery cost, slashed. The nursing charge, slashed. The cost of medicine, slashed.
Wait, that's insane. The surgery is the same whether I'm in a ward or a suite? The surgeon doesn't use golden scalpels just because I have a private room.
Actually, in many Indian hospitals, the doctor's fee is linked to the room category. But even if it isn't, the insurance contract says they will cut it. So, because you upgraded your room, a 4 lakh claim might get settled for 2.5 lakhs. You lose 1.5 lakhs just to get a private room.
That is massive. You think you're paying 20,000, but you end up paying 1.5 lakhs.
Exactly. It destroys the value of the policy. You feel cheated, but you're the one who unknowingly broke the rule.
So how do we avoid this? What do we look for?
You must check your policy document for no room rent capping. It should say single private room or any room. If your policy has a cap, port it. Get out of it. It's a leaking bucket.
Okay, no room rent capping. That goes on the checklist. What about consumables? I saw a viral tweet about a guy who was charged for 50 pairs of gloves and the insurance didn't pay. What's that about?
Yes. Consumables, gloves, masks, PPE kits, cotton, syringes were historically not covered. These are categorized as non-medical expenses. During COVID, this became a huge issue because the PPE kits cost thousands per day, and people were shocked when that part of the bill was rejected. Now, many modern policies have consumables cover as an add-on, or it's built in.
So that's another checkbox, another thing to ask about.
Yes. When you buy, ask the agent, does this cover non-medical expenses or consumables? If not, be prepared to pay 10 to 15% of the bill out of pocket, even with a good policy.
This is really getting into the weeds, but it's so important. These are the details that cost you lakhs. I want to pull back and make this real for people. We've talked a lot of theory. Let's look at some scenarios. The sources gave us a great comparison story, the story of Ravi and Meena.
This is a classic tale of two portfolios from the Legacy Diary, a perfect real-world illustration.
Let's start with Ravi. He sounds like a lot of people I know, a good guy, doing the right things.
Ravi is a diligent guy, 38 years old, salaried, works in Hyderabad. He's doing everything right, investing in SIPs, saving for his kids' education, paying his EMIs on time. But he made the mistake we just discussed. He relied solely on his corporate policy, which had a limit of 3 lakhs.
Which feels like a decent amount until something bad happens.
Until his father needed bypass surgery, the bill came to 9 lakhs.
Ouch, that's 3 times his cover.
So the corporate policy paid its 3 lakhs. Ravi is now staring at a remaining balance of 6 lakhs. He doesn't have 6 lakhs lying around in his savings account. Nobody does. So what does he do?
He goes to the VIPs we talked about earlier. He has to attack his own investments.
Exactly. He had to break his child's education SIPs. He emptied his emergency savings. He essentially cannibalized his future to pay for the present. The source notes that his financial clock was reset by 5 years. He lost 5 years of wealth compounding in 1 week.
I want to pause on that feeling. Imagine the feeling of logging into your investment app and hitting redeem all on the fund labeled Daughter's College. That must be gut-wrenching.
It is. It's psychological trauma as much as financial trauma. You feel like you failed your family, even though you were just unlucky.
Now contrast that with Meena. What did she do differently?
Meena had the same job, similar income, but she had a separate family floater policy of 50 lakhs, probably a base plus super top-up structure that we talked about. She paid a premium every year from her own pocket.
She bought the bodyguard.
She did. When a similar crisis hit her family, Her husband passed away unexpectedly, involving a long hospitalization. The policy kicked in. It paid the bills. Her savings remained untouched. Her investments kept growing.
So when the dust settled, Mina was grieving. But she wasn't broke. She had the space to deal with her emotional loss without a financial crisis on top of it.
That's the difference. Wealth isn't just about how much you make, it's about how much you keep when life hits you. Mina's wealth was secure because she had the shield. Ravi's wealth was exposed.
There's another scenario mentioned in the expert analysis that I found really interesting, the asset-rich family,
Yeah.
the business owner or the landlord.
Yes. This is a very common Indian mindset. I don't need insurance. I have a commercial complex, I have land in the village, I have gold. If I get sick, I'll just sell a plot.
It sounds logical. Land is valuable. Gold is valuable. Why pay premiums to an insurance company when I own land?
Because land is illiquid. A medical emergency demands liquid cash instantly. We are talking 24 to 48 hours to put down a deposit or pay a bill. You cannot sell a building in 24 hours.
Not at a fair price, certainly. You'd have to slash the price.
Exactly. If you have to sell a property in 2 days, it's a distress sale. You will get maybe 60 or 70% of the value. The sharks will smell blood. Or you'll end up running to a moneylender and taking a high-interest loan while you wait to sell. You're just digging a deeper hole.
So you lose value on your asset because you didn't have liquidity. The lack of a small insurance premium costs you lakhs on your big asset.
The lesson here is that even the rich need insurance. Not because they can't afford the bill, but to protect their liquidity and prevent fire sales of their hard-earned assets. Insurance is the fence around your property. It stops the hospital bill from squatting on your land.
That makes so much sense. It preserves the value of the portfolio. Now, there's one more scenario that I think is unique to our culture, specifically regarding siblings. It's not something you'd see in a Western finance book.
The dependent sibling scenario. This was a sharp insight from the video sources. In many families, there is one sibling who is financially more successful than the others.
The golden child, or just the one who made it to the metro city and got the IT job.
Right. Whether you like it or not, you are the family's insurer.
Yeah.
If your brother in the village or your sister who isn't working gets sick, who pays?
You pay. You can't just let them suffer. It's family. The call is coming to you.
You will pay. And it will come out of your savings, out of your child's education fund. So the expert advice is surprisingly pragmatic. Buy insurance for your dependent family members.
Buy it for them. Even if they don't live with me, I pay their premium.
Yes. Paying 20,000 rupees a year for your brother's premium is a lot cheaper than paying 10 lakhs for his heart attack. You are protecting your wealth by ensuring his health. It's a defensive financial move.
That is such a strategic way to look at it. It's not just charity, it's self-protection. It's a defensive moat around your finances.
Exactly. You are plugging a potential leak in your own financial boat.
Okay, we've covered the why, the when, and the who. Now I want to get to the how. Let's give the listener a cheat sheet, the action framework. The sources outline a 5-step safety net. Let's walk through them slowly.
Step 1 is the golden rule we've been hammering. Get independent cover.
Self, spouse, kids, parents, separate from your job.
Do not rely on your employer. Have a policy that you own, that you control, and that cannot be taken away by a layoff or a career change.
Step 2.
Go big or go home. Aim for 25 lakhs to 50 lakhs coverage using the base plan plus super top-up strategy we discussed. Don't fall for the 5 lakh myth.
Step 3.
Vomit the truth. Full disclosure. Tell the insurer everything. Smoking, drinking, that old knee injury you had in college. If you lie, you are donating premiums, not buying coverage.
Step 4 is about the fine print. Check the caps.
No room rent capping. That is the mantra. Make sure you are eligible for a single private room so you don't get hit with proportionate deduction. And while you're at it, check for consumables cover.
And finally, step 5. This one surprised me a little.
He has an agent.
Really, in the age of apps and chatbots, I feel like millennials and Gen Z are so resistant to talking to humans. We want to do everything on an app, get a discount.
I get that. The friction is annoying. But the source material makes a crucial distinction. Purchase versus claims. Purchasing online is easy. The user interface is beautiful. But claims are ugly. Claims are messy.
Paperwork, queries, bring this document, doctor's signature missing, the stamp is wrong.
Exactly. When you are standing at the hospital admission desk at 2 a.m., panicking because the cashless approval hasn't come through, do you want to be chatting with a bot named InsureBot3000 who keeps pasting FAQ links?
No. I want a guy named Suresh who says, Don't worry, I'm calling the TPA right now. I'll handle it.
That's the value of the agent. They are the interface between your panic and the insurer's process. The sources suggest that the small commission they earn is worth the service they provide during a crisis.
So don't be penny-wise and pound foolish. Get an advocate.
Correct. Your future self will thank you.
Before we wrap up, I want to touch on the legacy aspect of the legacy diary. The book talks about documenting things. Why is documenting the insurance details so critical? It seems obvious.
Because of the hidden treasure problem. We have seen cases where a person had a policy, maybe a credit card insurance, or a separate policy they bought online years ago, but they never told their spouse.
So they die or get incapacitated in an accident.
And the family pays the bill from savings, never knowing that a policy existed that could have covered it. The money was there, but it was invisible.
That is tragic. To struggle financially when you didn't have to.
That is why the diary concept is so powerful. It forces you to write down, I have policy X with company Y, number Z, contact person A. It turns invisible assets into visible ones for your heirs.
It's the bus factor.
Yeah.
If you get hit by a bus, can your family run your financial life?
If the answer is no, you haven't finished your financial planning. You've only done half the job.
This has been an absolute eye-opener.
Yeah.
I feel like I need to go and check my own documents right now. I want to quickly recap the key takeaways before we wrap up, just rapid-fire style.
Let's do it. 1, medical inflation is the enemy. Costs triple every decade. Your coverage must reflect future costs, not today's prices.
2, health first, wealth later. No portfolio survives a broken body without insurance. It is the foundation of everything else you build.
3, buy when healthy. The moment you see a doctor for a chronic condition, your insurance window starts closing. The 91st day rule is real. Lock it in when you're young.
4, disclosure is non-negotiable. Lying on the application guarantees a rejected claim. Just tell the truth. It's that simple.
And 5, cashless is king. Stick to network hospitals. Reimbursement requires you to front the cash and fight for it later. Cashless keeps your liquidity safe when you need it most.
Powerful stuff.
Yeah.
You know, we started this by saying middle-class families are fragile. But with these tools, this shield, we can actually make ourselves anti-fragile. We can withstand the shock.
That's the goal, to take the luck out of the equation, to replace hope with a plan.
As we close, you always have a reflection question for us, something to make us squirm a little bit.
I do. And this one hits home for anyone with kids or big dreams. I want you to ask yourself, if a medical emergency costing 15 lakhs hit your family tomorrow morning, would the hospital bill be paid by an insurance company, or would it be paid by your child's future education fund?
Wow, that puts it in perspective. You aren't paying with money, you're paying with dreams.
Exactly. Whose future are you mortgaging?
Listeners, don't just let this episode play and move on to the next one. Open your files, check your coverage amount, check for room rent capping. If you have a legacy diary, fill out that medical page. If you don't, just write it down on a piece of paper and put it where your spouse can find it.
Financial awareness today is family protection tomorrow.
Thanks for diving deep with us. We'll see you next time.
Stay safe and stay insured.